This video is actually going to cover a question that I get pretty frequently asked by a lot of people, and it's revolving around what indicators do I like to use when I trade. But before the video starts, what I do want to mention is that I'm going to be doing a day trading one-on-one course. There's a lot of questions that I get asked by a lot of people, the same questions, and I want to start answering those in videos because I think that would probably provide more value than answering each question individually. And that being said, all of these blue logos that you see, or anytime you see a video with the blue logo, just know that it's part of that day trading one-on-one course. And if you guys have any questions, make sure you DM me. I'll do a video about it, or I'll answer it. And with that being said, I'll let the video get started here. So really, before I get into the indicators, one topic that I did want to discuss first is what charts do I use, right? So three charts that I use are the 1 minute, the 5 minute, and the daily. And what those essentially are is on the 1 minute, all that really means, to keep it super simple, is each candle, right, as you see on the chart, each candle is going to represent 1 minute of what the price is doing. And on the 5 minute chart, it's going to represent 5 minutes of what the price is doing. And, if you couldn't guess already, the daily chart is obviously 1 day for each candle. So, with that being said, I marked out very quickly here. I marked out from 9:15 to 10:30 on both charts, so you guys can see the difference between what the 1 minute and 5 minute is showing you. It's the same exact stock, the same price, the same action, the same everything. But it's going to show up a little bit differently on different charts. But ultimately, it's going to show you the same thing, but it's going to be represented a little bit different. So for every one candle on the 5 minute chart on the left side, you're going to have 5 candles. So for every 4 candles, you're going to have 20. For every 5, you're going to have 25. So on and so forth. So, for example, you guys can see this uptrend here, right? There's a string of green candles in a row. I want you guys to pay attention to how that looks on the 1 minute, right? Versus the 5 minute. On the 5 minute, you only have, 1, 2, 3, 4, 5, 6, 7, 8, 9 candles in a row in that time frame I marked out, and you have you're gonna have 45 candles of price action on the 1 minute, and you're gonna have red candles in there too, even though you didn't see any on the 5. So that's probably the first thing that's important to understand. If you're trading larger companies, if you're trading your Apples and things of that nature, and your Teslas and Amazons, you're most likely going to be using a 15-minute or a 30-minute chart if you're day trading. And if you're swing trading, you're looking to take a position and leave it overnight and hold it for a couple weeks or a month, then you're probably going to be using your 4-hour chart. So you guys can experiment with that. Use what works for you. But me personally, I use the 1 minute and the 5 minute. So very quickly to start the video, I actually listed all the indicators that I use in order from most important to least important, the things that I use the least, which is the 200 exponential moving average, and I'll explain what that is later in the video. But the one that I wanted to focus on first is the most important, hands down, without question, it's price action. And what is price action, right? So price action essentially is the way the candles are forming on the chart. And that's what's going to give you your overall market structure. And what is market structure, right? So anytime you have a stock that's in an uptrend, right? It's going up more than it's going down. You're going to have higher highs and higher lows, right? Just like I drew out on the chart here. So in the green, you could see what an uptrend basically is. And in the red, you can see pretty much what a downtrend is, right? So that's lower highs and lower lows. So uptrends, higher highs, higher lows. Downtrend, lower highs, lower lows, right? So price action is always number one. It's the number one indicator simply because it's real time, right? It's not lagging behind the price at all. With any other indicator that you can possibly put on your chart, it's going to be behind to a degree, right? But what's happening with price action is it's dictating real time, right? What the price is currently doing, right? So what I mean by that is if you see a candle, right, and you see a very large green candle, you kind of know you missed the move, right? I mean, anytime you see a large candle, I want you to immediately in your mind think extended, right? So, you essentially want to see, if you see a lot of candles in a row, like you see here, right? You have, and this is a 5 minute, right? So 1, 2, 3, 4, 5, 6, 7, 8, 9. You have 45 minutes in a row, right? Because nine 5 minute candles is 45 minutes. You have 9 candles in a row, right? Where you haven't had a red candle yet. There's been no pullback whatsoever. So at some point it has to happen. So if I were to see that, right, I'm waiting for at least 2 or 3 red candles, and then I'm looking to make my entry at the first candle to make a new high. So this is actually a really good example because this is a really nice entry. And where you would exactly get in here is literally right here. It's at the break of this candle. As soon as this makes a new high here, right, you're going to be in right at this point. This is called an apex point, right? So, this is the point to get in after a pullback. So that's always your number one indicator. And what I'm actually going to show you guys on the the daily chart now is I'm going to show you guys what uptrends look like, what the overall uptrends and downtrends look like, because that's going to be key. So, this is obviously Apple, right? Everybody's heard of Apple. And, I've identified 3 uptrends here that have taken place recently. And how do you use that, right? Like, how is that an indicator, and how does that make sense? How does that help you? So very simply, what you want to do is once you identify these channels, right? You identify where the higher highs are happening, the trend line, and you identify where the lower lows are taking place. You can use that to very easily identify a point where you can enter, right? So let's say, it's pretty easy to say on a chart that's already happened. It's easy to say what you would have done, right? So let's pretend that this is all the information I had. It is October 5th, 2020, and none of the rest of that uptrend has happened yet. So this is what we're looking at, right? Once you see that it makes this low after breaking through this resistance here, and once again, one thing that you're going to hear me say constantly is when resistance gets broken through, you want to see it become support. So this was acting as resistance. As you guys can see here, it's resistance, right? In quite a few places, right? Once that gets broken through, you want to see it become support. So it did that. If you kept the line right where it was at, it would tap it down to a penny right here. And these are daily candles, right? So how do you play that, right? So what I would be saying to myself is, if I had this here, if this is what I'm staring at, right, I'd be saying to myself, when it hits that red line again, I am literally going to take an entry. And you can keep your stop loss short or tight, and you could say to yourself, you know what, if I want to get in at $106, then if it hits 104, I'm out. That's perfectly fine. You can keep it tight because you could always get back in, right? But this gives you such a better point than if you were just to see these like large green candles, you've already missed the move. Rather than force something, you always want to get in on the bounce of something, right? So that's why price action is the most important indicator. So, that being said, if you took that entry when it bounced off, look at what happened. You bought at 160, right? It almost tapped into the penny, right? You bought at 106 rather. And look at when it went up to. It went all the way up to 119, right? And then all of a sudden, you could be making a decision there, and you could say to yourself, okay, do I get out? What do I do? Obviously you're not going to be able to hold it the entire channel. So it's very good to say to yourself, when it gets a third of the way up, I'm going to cut a third of my position. When it gets 2/3 of the way up, I'm going to cut 2/3 of my position. When it hits the very top of that channel, I'm going to be completely out of it, and that's okay to do. And that's how you use price action. And even on a 5 minute chart, it's going to be a lot of the same, right? So you're going to have your market structure take place on any time frame. It doesn't matter what the time frame is, but you can literally do this all like every day, every time frame, every stock you trade. You're going to be able to identify highs and lows and where you'd be able to play them, right? So, you really want to see something like Apple, you want to see it react well to those trend lines. And, I'll do another video on trend lines in the future, but I just kind of wanted you guys to really understand what overall market structure and price action was in this part of the video. So with that being said, let's see what's next. In this part of the video, I'm going to cover our most fun indicator to say. It's called VWAP, Volume Weighted Average Price. And what is it, right? So it's essentially a measure of what the price is doing relative to the volume, right? So, if you look at the bottom part of the screen, right, these are my volume bars, right? And what that's essentially dictating is it's dictating how many shares have been traded in that period of time. So in the case of a 5-minute chart, this is going to tell you, each one of these is going to tell you how many shares have been traded within that 5-minute period of time. So, that being said, what you're going to notice about VWAP, right, is that it reacts more strongly when there's a lot of volume present, right? So in this middle of the day, you can see that there's these pretty large moves. The price is moving, but it's doing it on significantly less volume than either at the open or the last hour of the day, which is commonly referred to as the close or power hour, or essentially all it is 3 to 4 o'clock, right before the closing bell. So from 9:30 to 10:30, you're going to have the most volume, and from 3 to 4, you're also going to have a surge in volume, but more than likely not as much as 9:30 to 10:30. But that being said, where did VWAP react, right? It reacted when there was a greater increase in volume and the price went up. You saw this move, whereas even if the price moved up without volume, it was much more gradual, right? And then you could see it kind of like steepen up a little bit, right at the close, because again, there's just a heavier presence of volume. So why is VWAP significant though? Is it just because of the volume? Well, no. So VWAP is significant because pretty much every group that's trading any stock is looking at VWAP, right? So, whether it's your retail traders, whether it's your professional traders, whether it's institutional traders, people that are trading for like hedge funds and endowments and things of that nature, they're going to be using VWAP to say to themselves, okay, where is this trading in relation to VWAP? And sometimes if it's too far off VWAP, you might want to wait until there's a bounce off VWAP. You don't want to buy too extended off of that average. So, that being said, a lot of institutions will actually use this to gauge how good of a price they're getting for their orders, right? So as close as they can get it to VWAP, the better, right? So, cheat, right? Like do what they do, copy them, literally act like you work at a hedge fund and say to yourself, okay, how far is this off VWAP? Because the further it is off VWAP, the not so great of a price you're getting there. So, that's how VWAP works. Very, very straightforward though. If you look on the chart here, it's very easy to see. Just straight up to, if it's above VWAP, we consider it bullish, meaning we think it's going to continue to increase in price. But if it's below VWAP, right, then we're going to say to ourselves, okay, it's bearish. It might keep going down here. So what you want to see is really above VWAP. That means it's still strong. It's okay. So even though Apple came back down and it hit it momentarily here, it was still okay. And what a lot of people will actually do is, and what you can do too, is, you can actually play that bounce off VWAP. And that's what the setup is called, a bounce off VWAP, right? So you wait for it to hit VWAP and then you can buy your shares, and whether, your stop loss is, a couple cents or, 50 cents or whatever it is, you can bet that that's more than likely, when it's in an uptrend, a pretty good spot to get in if it's only bounced off of it once. So, in a nutshell, that's VWAP, and we're going to hit our exponential indicators next. All right, so here we're going to cover our exponential indicators. First and foremost, before I start on them though, I want to apologize that I haven't mentioned in this video yet that price action is the number one indicator. So I apologize for that. I might have slipped up a little bit, but what our exponential moving averages are, it's in the case of our 9 exponential moving average, right? It's the average of the last 9 candles. So it does not matter what chart it's on. It could be the 1 minute, could be the 5 minute. It's whatever that is. If it's a 1 minute chart, it'll be the average price of the last 9 minutes, right? If it's the 5 minute chart, it's going to be the average price of the last 45 minutes, right? So, the 20 exponential moving average, same deal, 20 minutes. And, I'm not sure what 20 times 5 is in terms of minutes, but that's what it is on the 5 minute, the 200 exponential moving average. The 200 exponential moving average is an average of the last 200 candles. But, the thing with the 200 exponential moving average is, by time a stock hits the 200 exponential moving average, I'm just not even interested in it. So I don't want to spend a ton of time on it. It's something that you should have on your chart. It's something that some stocks will react to, and it's an indicator at the end of the day that a lot of people are watching. So it's not bad to have on the chart, but it's not something that I use a ton. But when it comes to the 9 and the 20 exponential moving averages, these are two that I'm essentially going to use in tandem, right? I'm going to use them in relation to one another. And what do I mean by that, right? So what I mean by that is if you guys look at the chart, right? What I want you guys to focus on is look at what happens. It crosses over. And I've said this multiple times. Once it crosses below anything, it could be a support level, could be a breakout level, could be a moving average, could be VWAP, which we just covered. Whatever it breaks below, I want you guys to start expecting it to become resistance, right? So it might have a hard time. Just expect that it might have a hard time getting back above, right? It might hit its head on it, right? Now, in the case of Apple, it didn't necessarily do that, but what did happen, right? You guys saw the moving averages, right, cross over. So you have the 20 in blue, the 20 exponential moving average of the last 20 candles. You have that in blue on top of the 9, right, in gray, this gray line here. And what happens is once it crosses back over, right, in an uptrend, the blue is going to be under the gray moving average. The 20 exponential moving average is going to be under the 9 exponential moving average, right? So, I want you guys to say to yourselves, if the 9 exponential moving average crosses down below the 20 exponential moving average, then I want you guys to immediately say in your mind, downtrend, right? That's a downtrend. And, is that always the case? It's not, but more than likely it is. And, when you're first starting out, that's going to be a really good place to start with it. And from there, you're really going to see a lot of the things that take place and how it kind of reacts to different things. Now, this is a 5-minute chart, right? What does it look like on the 1 minute? So if I drop this down to a 1-minute chart, right? Let's see what this looks like. So as you guys can see, right, it's following the same channels that it did on the 5-minute. There's just 5 times as many candles because it's now a 1-minute chart as opposed to a 5-minute chart. So, as far as like where I got these indicators from, they're just what I have found to work best for me. Some people use a 50 exponential moving average or they use a 100 exponential moving average. You can experiment with that, right? And see what works for you. To my point on the moving averages though, crossing over, on the 1 minute, you could really see this a lot more clearly. Now, the moving averages on the same moving averages, the 20 on the 1 minute is going to be in a slightly different location than on the 5-minute because it's taken into account the last 20 5-minute candles as opposed to the last 20 1-minute candles. So, again, when it crosses over, I want you guys to think downtrend because look at what happened here, right? So, you have a pretty clear downtrend, right? Higher highs, lower highs, lower lows, right? And you see that kind of like take place right here. You see a channel, right? Right? So, what happened here to the moving averages? They crossed over. And the 20 is above the 9 exponential moving average. So look at what happens when it crosses back above, right? If it's resistance and it breaks through, right? The moving averages are acting as resistance here, right? It taps, it can't get through. Taps, it can't get through. Taps, it can't get through. Even taps the 9 right here, and it just can't get through. But when it finally does, and the moving averages cross back over, right? What happens? It becomes support. Look at that, right? So it literally bounces right off of it now, right? Because now you're starting an uptrend, right? And does it stay like that forever? No, you're going to see it go below and you're going to see it try to hold that price. But the moving averages never crossed over. They crossed over very briefly here, but not enough to signify a downtrend. and you can see that it's very obviously acting as support right here, right? And then when it breaks below, it just doesn't like staying below that too often. And why is that, right? Because when you guys see this like start breaking below any level, it could be the 20 exponential moving average, could be VWAP, it's most likely going to have to try to break it 3 or 4 times before it actually does. And what you're also going to find is that some stocks react to these indicators better than others, and that's why price action is the number one indicator. But that being said, you're going to notice very quickly what bounces off what indicator, right? It's not going to take long for you guys to figure out. Okay, we're in an uptrend. It's respecting that 9 moving average, that 9 exponential moving average. I could put that on my chart, and I can take trades off that, and I just have to be careful. So, for example, if you were to say to yourself, the next time it bounces off the 9 exponential moving average, I'm going to take it, right? Maybe you buy right here at 131, right? And then, you could have rode this all the way up theoretically before you really get a real pullback up to 132, right? And if you're using bigger share size, that's a big deal, and it's going to be a larger move on some other stocks, But that being said, you can use this in such a multitude of ways. Even the 20 exponential moving average, if you took the bounce off here and you said, okay, I'm going to take the first candle to make a new high, you're in at 132 and you pick up almost 50 cents a share. Now, on an $130 stock, you're not going to use the 1 minute, so the moves are a little bit smaller here. But, that being said, if you have a smaller stock, you have a $5 stock, $4 stock, then, you can bet that 40, 50 cent move is going to be a big deal because you could take way more shares of it, right? You could easily buy 1,000 shares or way more easily than you can of an $130 stock. So that could be a big deal. That being said, I want to show you guys, if you guys intend on using these indicators, I want to show you how you can put them on your chart, right? So I'm going to show you in a couple ways here, right? So first and foremost, the platform that I'm using for charting right now is called eSignal. Now, eSignal is $180 a month, and if you're just starting out trading, there is absolutely no way you're spending $180 on charting every month. So that being said, what you can actually do is use something like TD Ameritrade, which you may have heard of, and there's a couple other charting softwares out there that are significantly cheaper. TD Ameritrade is free, but if you use something like, it's called TC2000, right? TC2000. If you just Google that, you'll see that you can get charting software for $20 to $30 a month. And there's a couple other free ones that you'll find, but it's really a lot of the same, right? So what I'm actually going to do is I'm going to pull up my TD Ameritrade account, and I'm going to show you how to put these on your charts right from TD Ameritrade if that's what you're using. So you have your chart up. It's TD Ameritrade. This is our 5-minute chart. What you want to do is you want to click on this little potion bottle. It looks like, and I'm going to exit all of these out just so you can see how I do it, right? So you're just going to type in moving average, right? And you're going to look for the one that says exponential, right? And you're going to put 3 of them on your chart if that's what you want to use. I use 3, so I'm going to put 3, right? And then you click this little like gear right here, and that'll bring up the settings. And you could very easily change it to whatever length you want. So now that's a 20 exponential moving average. And you could change the colors as well. So I'll make this a gray one since the 9 exponential moving average is gray on my other chart. And then this will be my 200, right? And that'll be our hot pink that it is on my other chart. And we could even throw VWAP in there. All you have to do is type it in, and it'll pull it up for you. So, that being said, you can literally make this any color you want. You can make it look any way you want. Whatever sticks out to you. I'll make it orange in the case of this example. And you guys can see how this looks, right? Now, this VWAP on TD Ameritrade, it has like bands to it. So all you have to do is you go into your studies, and you just have to click off show plot and all this stuff, and it won't show you the bands. And then you'll just get your straight up your VWAP line in the orange. You get your 20 exponential moving average in the blue. You get your 9 exponential moving average in the gray, and then of course your 200 in the pink. So it's literally that easy. It's not very difficult to do. And if you guys have any problems with it, truth be told, just shoot me a DM or send me a screenshot of what you're looking at, and I'll help you figure it out. It shouldn't be that difficult no matter what you're using. And that being said, those are my indicators. That's what I use. And If there's anything that you take away from these videos, or this video in particular, it's that price action is the number one indicator. Because at the end of the day, if I'm sitting here trading by myself, this is really how my chart's gonna look here, right? So, I'm not gonna have a lot of these indicators. I'm gonna take this off. I'll take this off. I'll take this off. And this is really all I want to have on my screen, because I don't really need, after watching it so much, I don't need the lines to tell me that it's extended off the moving averages right here, for example, right? And that's something that you guys will see too. So the only thing that I would use if I'm trading by myself is VWAP. I put the other indicators on there for example's sake, but VWAP is really the main one you're going to pay attention to. Price action's number one. And then you have your other exponential indicators that you guys can kind of mess around with. You can make them 20, you can make them 50, you can make them 100. Really whatever works best for you, and whatever works best for you, whatever you see the best. So that being said, guys, keep a lookout for the blue logo. That's going to be part of this Day Trading 101 series that I'm doing. And, I'm going to get around to making more Day Trading 101 videos this week. So stay on the lookout. See you guys soon.